Hello, and welcome to Total Tax Accountants. Today, we have an interesting topic that will help homeowners and buy-to-let people. In this video, we will explain capital gains tax on residential property and what are the capital gains tax rates applicable. So what are capital gains? Capital gains on property are essentially the profit you make when you sell your property for more than what you had paid for. In the context of residential property, it refers to the difference between the selling price minus the original purchase price and accounting for any related costs, such as improvements and expenses. You can also deduct the buying and selling cost, such as solicitors' legal and letting agents' cost. Let's dive in deeper. The formula for calculating capital gain on a residential property is quite straightforward. You simply take the selling price and subtract the original purchase price, as well as any costs for improvements alike. Furthermore, any cost associated with the purchase and selling of the property are also deducted to reach the chargeable gains. The rate at which capital gains are taxed depends on several factors, such as how long you've owned the property and your income bracket. In the UK, the capital gains tax rates are 18% and 28% for individuals. You may only pay 18% tax rate if all gains within your basic tax rate threshold, or pay 28% tax rate if all gains are above your basic tax rate threshold. You may also end up paying 18% on some of your gains and 28% tax rate on gains above basic tax rate threshold. To reduce your capital gains, there are several exemptions available. These include, for example, private residence relief and lettings relief allowances. It's crucial to evaluate your situation to confirm if you are eligible for any exemption relief. For example, if the property has ever been your main residence, then you can claim private residence relief for all the time it's been your main residence. This will subsequently reduce the overall capital gain tax you need to pay. Selling a residential property is a significant financial transaction that has tax implications. Understanding how capital gains are taxed can help you plan better and possibly save money. Let's take a real-life example next and elaborate how capital gains are taxed. Let's say Jane bought a residential property in 2010 for £200,000. Over the years, she spent £50,000 on improvements like new kitchen and a bathroom. She decides to sell the property in 2023 for £400,000. Firstly, to calculate the capital gain, we take selling price £400,000 minus purchase price and improvement cost of £200,000 and £50,000. Now minus annual exemption allowance of £6,000 gives taxable gains of £144,000. This is the amount on which Jane would have to pay capital gains tax on, assuming Jane is a higher rate taxpayer and all her capital gains fall into the 28% tax bracket. Her capital gains tax would be calculated as 28% of her chargeable gains of £144,000, which generate the capital gains tax liability for Jane as £40,320. However, Jane could potentially reduce her capital gains tax liability by applying for any exemptions for which she's eligible for. For example, if Jane had lived half of the length of time in her property as her main residence, she could claim for principal private residence relief and reduce her capital gains tax liability by half. Now let's talk about when to report your capital gains on residential property. Capital gains on residential property needs to be reported to Revenue and Customs within 60 days of the property disposal. You must report capital gains via capital gains own tax return in a timely manner to avoid late filing penalties. In summary, you must report and pay all your capital gains tax within 60 days following the property disposal. Thank you for watching. If you found this video helpful, please hit the like button and consider subscribing for more finance-related content. See you in the next video.